Welcome back.
Welcome back.
Okay, so back in December, we told our investors that all the signs were pointing to serious trouble ahead for Wall Street. And we sent out a series of videos that we recorded right here in the same spot. Unfortunately, those predictions have been playing out. So the markets have taken a major hit and this uncertainty is everywhere. But we're here to remind everyone, right, why we've been positioning for this and encouraging our investors to diversify with hard assets like oil and natural gas alongside of us that generate real cash flow and aren't tied to the swings of the stock market. So speaking of the stock market, Jim, can you provide some insight on what has been going on and what your thoughts are on the chaos that has ensued in the last several days?
Yeah, so just bear with me a little bit because we need to go back in time a little bit to understand what's going on now, because history, although it doesn't repeat exactly, it really does rhyme. I think Mark Twain said that. So in 2008, what we ended up learning after the fact, especially if we saw the movie The Big Short or even the documentary called The Inside Job, but more importantly, reading the book, The Big Short, provided way more information than the movie. But what we learned was the banks were super leveraged. The mortgage companies were super leveraged. Basically, the entire banking system in Wall Street were way over leveraged, and the derivatives were not regulated. And we learned all this, that this was basically done by design. And we did a little video on this previously. So that is partially playing out today. So let's go back a little bit closer to history, a little bit further in time to 2019. So in 2020, COVID, essentially what the banks did was print $5 trillion. The Federal Reserve printed $5 trillion and gave it to non-bank financial institutions. So think of hedge funds and pension funds, okay? The reason we didn't have inflation in 2008 with the Fed money printing is they actually bailed out the banks directly. And so that money just stayed in between the banks and the Federal Reserve in that system. It didn't get into the economy. In 2020, during COVID, it didn't go to the banks themselves. It went to non-bank financial institutions and non-bank institutions. So that money did get into the economy. And then obviously 18, 20 months later, we had massive inflation. But we have to go backwards from 2020 to actually 2019 because history is repeating itself exactly from 2019.
Really?
Yes.
Today? What's happening today?
So people, even I didn't know this. Now, I was a financial planner for 15 years. I didn't know the crap that was going on until 2008. Really, my eyes were open. So there's something called a basis trade. And it's pretty unbelievable to fathom. And so there's a YouTube video that explains it pretty well. We'll put a link into these videos to that. So essentially, here's how it works. You're a hedge fund. You go and borrow money in the repo market. The repo market is basically a facilitating market where the bonds mature in days, not months, not years, days. A lot of major corporations, instead of keeping cash in the bank for like payroll, they'll go into the repo market. So these hedge funds go into the repo market and they borrow money. Let's say they borrow $990, okay? And when that loan comes due, they're going to have to pay, say, $9 in interest. They technically should have collateral for this, but they don't have the collateral. So what they do is they take the $990 that they borrowed and they go buy a treasury bond for $990. Then they post that treasury bond as collateral for the loan they took out before, which seems totally insane.
Yeah.
But it gets more insane.
Okay.
So then they're going to make that, a little bit of spread, right? They owe when that bond comes due, the amount they borrowed, they're going to owe $999. But the treasury bond's worth $1,000.
Okay.
So they're going to make a buck. But what they do is they go into something called the futures market, where they're going to sign a contract to sell that treasury bond say a month or 2 months into the future for a higher price. And the buyer of that bond is going to be a pension plan. And there's a dealer that will negotiate that contract. Okay. So the hedge fund then goes and sells the contract for the treasury bond at a higher price than what they paid for it and what they borrowed for it. So they're going to make an arbitrage. And when you do this on steroids, or in the financial world, leverage, 50 times over, you don't put up any real money and you make a lot of money. So essentially you turn what you might make a 5% return into a 30% return or a 40% return because it's on borrowed money. But there is risk. If the price of that treasury bond that you put up as collateral, even though you borrowed the money first, goes down, the repo market person is going to call you and say, hey, your collateral is not worth enough to cover the money you borrowed. Give us more money. And you got to come up with the money. Additionally, at the same time, the dealer that you sold this treasury bond to into the future at a certain price, and now that price has gone down, the dealer is going to call you and say, hey, you're short collateral. We need more collateral. And you're going to tell the dealer, I don't have the collateral.
Right.
And this is where it gets completely insane. The dealer that you sold this contract to does not have any recourse because the contract, the treasury bond, they can't take it away from you because it's been pledged as collateral to the repo market. And oh, your pension plan is now left holding the bag. So the dealer's got to scramble and take that contract away from you and give it to somebody else. And they're going to be out money, or you're going to owe them cash. So there's a lot of questions like, A, why is this even legal?
Right.
Number one, and it's totally insane. Why would anybody ever do this on 50 times leverage, not one times? And then 3, why would your pension plan not just go buy a treasury bond directly? Well, there's lots of reasons. One, the pension plan, the reason they're buying it from the futures market is that they too can also get it via leverage. So it juices their rates of return. Okay? Assuming they don't lose.
Okay.
Now, why do hedge funds do this? Well, because they know they're going to get bailed out. Who issues the treasury bond? It's not the US Treasury. It technically is, but who gives them the money? The Federal Reserve. So the Federal Reserve is basically bailing themselves out. Okay? Totally insane, completely insane.
Right.
Now, here's what happens. And this happened in 2019. The repo market, when this same exact trade blew up in 2019 in September, the repo market, the rates skyrocketed. The value of these repo loans went down big. And the liquidity, or in the system, the dollar liquidity froze worldwide, not nationwide, worldwide. It froze. And so remember, we did a little video like, hey, the repo market went haywire before COVID, and then they ended up bailing out. You know, the Fed used COVID as a cover to bail out institutions. Okay. Now, the Fed bailing out banks and bailing out, their buddies on Wall Street is nothing new. Go read the Creature from Jekyll Island, 600-page book on the history of the Federal Reserve. They've been doing it since 1913. That was the whole premise of the Federal Reserve Act. You, Congress, can borrow and print as much money as you want, and we'll give you the money, but our friends on Wall Street and the banking system are going to get bailed out from time to time. That was the partnership deal. So that's nothing new. Well, fast forward to today, it's happening again. The same trade that blew up in 2019 is happening again. Only it's twice the size.
How do you know that this is what is going on? Because, all I'm seeing on the news is it's all about the tariffs, but this sounds like it's what's happening behind the scenes.
This is what's going on behind the scenes, and you have to dig to find it. Okay. But it is out there. It's not on CNBC. It's not on Bloomberg. It's not on the nightly news. That's the tariffs, which is literally a sideshow. It's theater or cover for what's really going on in the banking system. And by the way, the Federal Reserve has actually proposed a fund of sorts to do just this, to bail out the hedge funds that are in trouble on this trade.
Huh.
Imagine that. It's called a facility, but it's the same thing.
Wow.
So yes, there's market turmoil. The market tanked last week. It's up this week because the tariffs are on pause for
That's
90
right.
days. But don't kid yourself. The current underneath the top of the water is strong and it is not pretty.
And it will pull you under, right? That
It is
current.
not pretty. This trade is blowing up. And it is twice as big as 2019-20.
Okay, so a lot of people have the mentality of like, okay, you don't lose money unless you sell what you've got in the stock market. So just hang on, hang on. Like when do you know when to pull the plug?
That's a great question. I was taught all those talking points too when I was a financial advisor. You're in it for the long term. You don't panic and sell. It will come back. You just have to ride the waves through the market's ups and its downs, and you'll average this. It's all a bunch of bullshit. And I know this because we have the chart. The Charlie Brown chart is what we call it. The S&P 500 going back to 1900 has done this 4 or 5 times, where it goes down more than 20%, more than 10%. It'll go down 30, 40, 50%. How long does it take to get your money back? Oh, it's not 3 years. It's not 5 years. It's not 10 years. It's 15 to 20 years. Yeah. So this hold, don't sell, it'll come back. Well, what if you're 50 and your 401k gets cut in half? You ain't retiring.
Right.
Because what you thought you were going to have based on your financial advisor's nice, pretty chart is not ever going to come to fruition.
Yeah. 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 Interesting. Okay. Is there more that you want to say about Wall Street and what's going on right now?
Yeah. So the reason we saw everything in red last week and even some this week, including oil and natural gas, I think natural gas is up today, but it was down the last couple of days. It's because these same hedge funds, this is not their only trade, right? They're selling everything in the kitchen sink to raise liquidity for these margin calls. That's what's going on. They will sell everything and ask questions later, figure it out later.
Including nat gas and oil.
Everything. The day during COVID, the day oil went to minus 38, that wasn't the real physical oil market. That was a Wall Street options contract that was going to expire the very next day. And the Wall Street traders that owned that contract on Thursday, it was going to expire on Friday, meant that if they didn't sell that contract, they were going to have to take physical delivery of a shit ton of oil, and they had no place to store it. So they called Exxon up and say, hey, we'll pay you to take this contract off of our hands. That's why I went negative 38. Had nothing to do with no demand for oil.
Interesting. Okay.
Wall Street banksters.
So when we see nat gas and oil prices declining right now, it's getting caught up in the Wall Street shit show that's happening right now, but it's not the actual price, right?
Yeah. I mean, oil to some extent, I can make an argument that the tariffs, whether they're on or off, who knows, what's going to happen. But if they stick, it's going to decrease economic activity because the price of things are going to go up.
Yeah.
People are already hurting from inflation with groceries and food and everything else. So that's going to decrease economic activity. So yeah, oil demand in the short term will go down, not by a ton, but it'll go down. So maybe you can understand oil. Natural gas has zero reason to go down. Zero. We pointed this out in our Outlook, which I think we did late last year, and then we updated again in January. The conference we were just at not only hammered home, not only are we dead right, but we're probably very conservative.
Yeah. Well, let's shift into talking about some of this. So before we get into talking about the conference, I want to just celebrate that last week we closed on $1 million diversified oil and gas royalty asset with a 19% return. And that's an immediate return, no waiting for wells to be drilled or long-term projections, right? It's like that is actual cash flow. And we welcomed, do you know how many investors were in this one?
I don't remember, but quite a few are new investors.
Yeah.
It's the first time. Yeah.
we welcomed several brand new investors to oil and gas, and it's really cool because we're seeing people get it, right? And we are building like this really strong, diversified portfolio together alongside of them. So it's great.
And, interestingly, when we signed the contracts for that asset, it was yielding 17%.
Yeah.
But we knew, because we saw the seller's royalty checks, we knew that the price on natural gas on those checks was 220, I think.
Yeah.
And the nat gas price was already up to 354. So we knew that was going to jump. And then they had 4 wells that were drilled but not turned on yet. And we knew those wells were going to be coming online. And when all 4 of them do, we'll be north of 20%. But the change in natural gas price brought us immediately to 19%. And yeah, that's our out of the gate cash flow return. Obviously, a royalty check is nothing but how much oil and gas come out of the wells times the commodity price times our ownership interest.
Yeah.
So as we go forward, if the commodity price goes up or down, then our checks will fluctuate up or down.
Sure, but 19% is not. That ain't bad.
It's a strong argument for alternatives to Wall Street.
It is. Okay, so more about natural gas. We just got back from the Doug Gas Conference in Shreveport, Louisiana. And what we heard about natural gas demand, especially in the Haynesville, where we have mineral rights, in DeSoto, Sabine, what we heard there makes us even more confident, right? And where we're headed. So let's unpack that. One thing that was mentioned at the conference that really stuck out to me was that data centers are willing to pay $12 to $14 for natural gas.
It's currently at $3.75 or $3.70-ish.
I mean, that is wild. So, what is driving this level of just desperation?
So some things we heard at the conference. We heard there is a tsunami of demand coming. We heard the demand from data centers is insatiable.
Yeah.
And when they mentioned $12 to $14 an MCF for gas, we asked the question to the panel.
Yeah.
At what price for natural gas is it prohibitive to build the data center? And what was the answer?
There's none.
There isn't one. So that tells you that demand is insatiable.
Yeah.
It is coming. The thing that stood out to me on the data centers was, previously we wrote, and because it's what was out there at the time, that the electricity demand from data centers is currently at 4% of U.S. electricity. It's going to go to 9%. Okay, that's a little more than a double by 2030, 2 times. Well, since we wrote that
in the Outlook.
Yeah, in the Outlook 2 months ago.
Right.
We started noticing that the demand for data center gigawatts all over the place is quite a lot. And just the few that we know about, that we started doing, adding them together, and it's a whole lot more than 2 times.
Yeah.
In fact, on the panel, they mentioned the current data centers already, in operation. The racks of servers use 5 kilowatts an hour in electricity. The new data centers under construction, their racks of servers use 10 to 15 kilowatts per hour. I mean, that's at least 2 times, if not 3. Then, we heard from Goldman Sachs, I think said 50 gigawatts of power by 2030 for data centers. Well, just in the past 2 weeks, I've got articles, and when you do the math, it's over 20.
Oh, wow.
Well, that's 2025, not 2030.
Right.
And that's just a handful of articles, not even digging. We don't know what the demand's going to be, but I can tell you this, it's going to be a lot higher than anybody's ever telling you. Now, and how do we know this is real? Okay, well, first of all, there are a lot of, I think 504 data centers under construction. We have 5,000 currently, I think, but most of them are the old version, not the hyperscalers for AI. So these 500 are bigger and more for AI and the data centers. Natural gas demand, how do we know this is definitely coming? Well, how many companies building a data center are now partnering with a natural gas company or an operator to get behind the pipe power?
Right.
And that could be power, taking pipelines from the natural gas wells directly to turbines on site at the data center location, or it could be like what's in Louisiana, where Exxon's going to build 2 or 3 natural gas power plants that are not going to get connected to the utility grid. They're going to take that power and go directly to data centers. And it just came out today that Louisiana is also building a natural gas fired fertilizer manufacturing plant, which the feed for that is natural gas. So that's coming as well. But on the data center side, more importantly, the power, where's this power going to come from? You know it's real because there is now a massive backlog in the turbines to generate electricity from natural gas.
Oh, fascinating.
All of the major operators have announced 3 to 5 to 7 year wait times for the turbines. They can't make them fast enough.
I mean, so is that going to delay, though, this tsunami?
It could delay some of them, but some of them already have contracts. The ones that are under construction, they obviously already have contracts.
Okay.
You know, I saw somebody wrote on LinkedIn, maybe we don't need all these data centers.
Yeah.
And it got me thinking, all the way back in 2022, for the brief moment I was on Twitter, I think I lasted 6 months and I was out, that echo chamber. I was driving to Texas, and then you know me, I'm very observant with my surroundings. For those that don't know me, I don't really get around with a map. I get around with like things. I can read a map, but I couldn't, like, I lived in Charlotte for 40 years. To this day, I can hardly tell you street names and just know where to go because of what's there. So I'm driving to Texas and I start noticing all of these lights that are going up at every intersection on the highway, the on-off ramps, right? These big lights, they look like little spaceships up there way up high. They're really tall. And in addition, they're building lights along the on-off ramps, the like new LED lights. And I noticed this literally out in the middle of nowhere, not just the cities. It was in the middle of nowhere. So I get to Dallas and I'm starting to pay attention to like all the intersections. Well, all the intersections have all these gadgets now that they've put up, right? So these things that I don't even know what they are. They look weird. Some of them look funny. Clearly, some of them are cameras. Cameras are going up everywhere. These smart poles, and they're real things. They're not, this is not what ifs. You can go look them up. Smart poles are going up. When you see these nice new fancy light poles on city streets and town centers and stuff, like shopping centers, those are smart poles. There's all kinds of sensors in those poles. Yeah, it's a new light, but it's also all kinds of sensors.
They're all collecting data.
Bingo.
All of it.
All of this is collecting data, not just your cell phone when you walk into Target.
Not just my chat GPT search.
Or your Google search. No. It is every sensor on all of these gadgets is collecting multiple data points. Your EV car, heck, your gasoline car is collecting tons of data.
Yeah.
That is what's driving the demand.
Okay, it reminds me of an iceberg. You know, like what you see on the surface are the chat GPT searches or whatever you're uploading to the cloud, but what's below the ocean, right? That iceberg is massive. It's Internet of Things. It's all the smart stuff. And that's what these data centers are for. Yep. And not to mention all of the national security stuff, right? That's driving the AI movement. I mean, it's
AI weaponry.
That's right. It's a national security. It's not just fueling our like curiosity and our obsession with like technology. It is a matter of national security that we have these data centers and the ability to power all of this to stay ahead of China and other countries.
Right. And the demand for data is the new oil. It's a gold rush for data. Data is the new oil. It is not stopping. It is going to be bigger than anyone thinks.
Yeah.
And it needs a lot of power. And that power cannot be intermittent. So you can rule out wind and solar.
Right.
The ones that have wind and solar, that's for show. They have diesel generators on site.
Yeah.
I kid you not. They tell you that they're green and they're clean, but they're not. Nuclear is a decade or more away, even this small modular nuclear. It is natural gas. In fact, you know this because natural gas power plants are now in vogue and they are going up all over the place.
Yeah.
Including places in northern Idaho that just announced this morning, hey, we're going to build a new natural gas power plant, when 2 years ago they said, nope, never again. We're getting rid of hydrocarbons. We're never doing fossil fuels. So It is natural gas.
Yeah.
It is the answer. It's not going anywhere. It's going a lot higher. And the difference this time, 2 years ago, we know about the LNG exports. Okay, that's going to double. 2 years ago, the natural gas producers drilled in advance of this wall of demand. That's another thing we heard at the conference, a wall of demand coming, a tsunami of demand coming. They drilled ahead of that, and the demand didn't hit right away. There was delays in construction on the biggest facility. There was a fire at an existing facility that shut it down. And so they drilled, and so supply went up, but the demand wasn't there yet, and prices crashed to $1.50. Now, all of the producers we heard talk at the conference are saying, we're ready to drill, but we're going to wait till this demand actually comes to fruition this time. We just got burnt 18 months ago. Well, that demand literally starts the second half of this year when two natural LNG export facilities come online, including the largest that was delayed 2 years ago. Golden Pass down in Sabine Parish, not Sabine Parish, Sabine Pass, Louisiana.
Yeah.
On the Gulf Coast.
Yeah.
That hits later this year, including all the data centers. What we are seeing is we're going to see demand get way out in front of supply, and producers are waiting. So what that's going to happen is, even if let's say prices went to $550 today, and those first demand facilities under construction literally turned on today, it's going to take them 6 months to a year to ramp up production to meet that new demand. They're never going to catch up. The demand coming in the next 5 years, they are never going to catch up. And the reason we say this with high confidence is because we heard what? We currently produce 105 billion cubic feet of natural gas a day. We heard 130 to 132 BCF, billion cubic feet a day by 2030, 2033. That's what we heard at the conference, right? We heard something very similar at the conference in Pittsburgh in October. But what's not being factored in on that demand, and we heard everybody on the panels talking about that demand. Everybody's saying it. What nobody is talking about, except for one engineer that we heard in Pittsburgh, nobody's talking about the existing natural gas wells that are producing that 100, 105 billion cubic feet a day. Every well declines. We all know this. This isn't rocket science. Everybody knows this. They all decline.
Now, it takes, what?
Decades, but it does decline.
Right.
And depending on how old the wells are, it's going to decline. Mm-hmm. So there's a mix of some wells are 10 years old, some wells are a year old. So the year-olds are going to decline more than 10-year-old wells. And when you blend all that together, by 2030 or 2032, we're going to lose 30% of that 100 to 105 billion cubic feet that we currently produce today. It's going to go down to 70. So how in the world are we going to go from 70 to 132 by 2030?
Yeah.
We asked the question to a Wall Street analyst, right?
Mm-hmm.
Wall Street analyst that covers natural gas and oil and gas producers. Yeah. We asked that question. Boy, he got up and tap danced around it.
Yeah.
He didn't answer it because he didn't want to answer. He tap danced around that question and never answered because they don't have a solution. There's not enough drilling rigs in the country to make up that much supply in 5 years. It's never happening, which means prices are going through the roof.
Okay, so why is this the time to invest in natural gas, royalties, and mineral rights? With the demand going up as much as it is, the value of those are going to go up, right? So, I feel like we're in the sweet spot where we're able to buy these at a reasonable price. But what, next year, do you think,
that's a good question. So it's not just natural gas. We want to talk about oil too.
Gotcha.
Because as we've drilled the shale plays and oil, that same treadmill is starting to slow down, right? In the beginning, when you drill 10 wells and they start to decline, it's very easy to make up the decline because it's the decline of 10 wells. Now we have drilled tens of thousands and hundreds of thousands of wells. It's much harder to make up those declines with new shale wells, right? We're running out of the best acreage. The technology hasn't caught up to the second best acreage just yet, but it's close. So, but oil production is not peaking like forever, like peak oil, but it is topping out to where we're pushing the limits of current technology, but worldwide demand is not slowing down. You've got all of Africa, third world countries basically moving into the middle class, and they want refrigerators, they want cars, they want air conditioning, want all the things that we take for granted in the United States. That demand is going nowhere but up. So we want oil as well.
Yeah.
But to your question about natural gas, why is the time now? We heard this on the panel, one of the panels about mineral rights and royalties. You know, we just acquired an asset with a little piece of that asset is in the Permian, which is the premier oil play in West Texas and eastern New Mexico. It is the cream of the crop. The reason we've avoided buying there in the past is because every dollar is chasing that acreage. Every private equity firm, every family office, all the big, royalty shops are chasing that acreage, which drives the price up and our return down. So we have avoided it because we could get better returns somewhere else. It doesn't matter if the oil is a little less quality than the one in West Texas. It's all about math. The wells last just as long. It doesn't matter whether they produce less because we're getting a percentage anyway. So you just do the math. So we heard at the conference that the money out there in the Permian is now moving to the Haynesville because they see what we just talked about with natural gas. And we were one of the first to call it officially on record. Others have, hinted at a piece here and a piece there, but we called it. We didn't call it, and we're not patting ourselves on the back. We called it because we bought before it and prices tanked. We were like, oh shit, are we wrong?
Yeah.
And so that's why we went through 1,500 pages of other people telling us, what we wanted to prove whether we're wrong or right. Yeah. And it proved us way right. So we feel very confident in that. But as that money starts to move into the Haynesville, you're going to get more dollars chasing the same acreage. So maybe we don't look to the Haynesville for natural gas. There's other places for natural gas. Colorado's a blend of oil and gas. Wyoming's a blend of oil and gas. There's gas in Appalachia. So, that's why we are agnostic as to where we buy. The math just has to work. And the geology is good too. We don't have to have the luxury mansion on the best coast in the world. We can have a nice house at the beach and make a lot of money.
That's right. So when we were in Louisiana for the Doug conference, we also spent some time driving out as close as we could get to our acreage in DeSoto and Sabine, as close as we could get. Jim was so uncomfortable how close we got.
I thought I was going to get shot.
But I'm a little rebel. I like to ask for forgiveness instead of permission. So we got out there and got up close and personal.
Dirt roads, middle of nowhere.
That's right. Yeah. But what we saw, driving through DeSoto and Sabine was just activity everywhere. We saw pipelines going in. We saw drilling sites. We passed, access roads, pump jacks. So that was just visually what I was taking in. But Jim went back and looked up some data about what was going on around us. So could you share some of that with us?
Yeah. So since we acquired Sabine in late 2023 and DeSoto in 2024, I looked up just in the very close proximity of our acreage, there has been, I think, 10 wells drilled, and really 9 of those were late last year. So just a few months ago when gas prices hadn't really gone up yet. So they might be being turned on soon. And there were over 20 permitted just in the very close proximity. We're talking just 10, 15 miles of our acreage. What we saw.
Let me ask you a question about that. My grandfather always said close only counts, and horseshoes and grenades. So why is close good news for us?
Well, it shows, we're not in goat pasture. We're in the part of the activity. So that's the main thing, which we kind of knew with the maps anyways. but there is activity in the area. Just because there's wells all around us doesn't mean there's any activity of drilling activity around us. So it was nice to get out and see it. There was between our DeSoto acreage and our Sabine acreage, which is about 15 to 20 miles between them, there was, we suspect to be a rig drilling because we saw it on one of the presentations at the conference. We couldn't get down there though. The dirt road access was blocked off with staff of the operator, and the trees. We couldn't see the rig because it was so far back.
I could have gotten down there.
Yeah. Our DeSoto acres, by the way, I mean, there is zero road access to that. You can't see it from a road. It is in the middle of nowhere. Our Sabine acreage, I think we got on a well pad that was maybe a mile and a half from our acreage. It was the next section over. So we were close.
Next time I'm taking a drone, we're going to see that acreage.
Yeah, we're going to do a drone next time. Stay tuned.
Yeah.
Yeah.
So we're in a great spot and feeling really confident about Sabine and DeSoto.
Yeah.
That, I love that you've made a reference to like timberland, right? It's like we invested in timberland almost and it's a forest that's growing and it's gaining value every day. And when they harvest that, when they drill those wells, right, it's going to just really be worth the wait.
That's a great point because I went back and did some math. At $5 nat gas, our acreage, the wells in that area, when we ran our economics to begin with, we pulled wells around us, like comps in real estate, to see what they produced, because what a well produced a mile away is going to be similar to what our wells would produce. And when I not just pulled the monthly production to look at the first rate of return in the first year, which, by the way, it's north of 100%, I looked at the EUR, which is the estimated ultimate recovery. What does that mean? How much natural gas those wells are going to produce on the from when they were initially drilled. Doesn't mean you go back in and repressurize them. It's just the initial drilling. And looking at that data from the same wells around us, we're looking at 4.5, 5 times our money when these wells are drilled over the life of those wells, the initial life of those wells. But 50-60% of that's going to be in the first 2 or 3 years. So we're not just going to make 100% year one. We're looking at making 200-300% in the first 2 or 3 years of them drilling these wells. Have we held for a year and a half, going on to 2 years? Yes, we have. If they drill them in the next 6 to 12 months, who cares? We're making almost 100% a year.
Yeah. Okay. Moving forward, as we continue to build our portfolio, our investors' portfolio, what is your priority going to be as you piece together new assets?
Yeah, I really like the asset we just did because it was largely producing, mostly all producing. Okay, so there was immediate return. But on the Permian piece for sure, the reason that acreage was hot is because other places in the country might have 3 or 4 or 5 different depths that you can drill. The Permian is 15. Wow. And so not in every area, but 90% of it. It's like 15 different, we call them benches that you can drill.
Gotcha.
And there were 34 wells on that acreage in New Mexico. 28 of them were in 2 of the 15. So there's a ton of upside there. We don't know when that upside is going to be, but there's a ton of upside there. What I think we're going to end up doing is what we've done in the past is we did producing, cash flow only, and then we did growth only, which is mineral rights that are permitted or pre-permitted for wells to be drilled, but they haven't been drilled yet. So that's the growth portion.
The ahead of the bit.
The ahead of the bit. When they drill those wells, we'll make a lot of money, and then it'll start to add to the cash flow. So I think what we want to do is maybe have components of both in the assets that we bring going forward. So there's a lot of current income with some growth. So we might take a little bit ahead of the bit and pair it with producing royalties. So there is some cash flow. Now the overall, yield on this last one was 17% to start with, went to 19. The next one might start at 15% because we've got that growth component in there where there's no wells yet. And when those get drilled, that 15% will jump to 35 or 40.
Right.
And you'll make a lot of money back quickly. And then the long term, that 15 might be, 10, 20 or 25%. So we have to look and see how to put it together, but that's kind of where I'm thinking what the next asset's going to look like.
Gotcha. Sounds good. Yeah. Well, okay. So if you had to boil all of this down, like what's one thing you want investors to know right now?
We hear a lot of people tell us they're really scared about the stock market. The problem is, 401ks and IRAs and all that was written to the tax code like in the 1980s. So there's been 40, 50 years of indoctrination, me included, for until I woke up to it, of this is how you save for retirement. This is how you build wealth, not with real assets, with paper assets that Wall Street manipulates and will crash periodically. And you get told a sales job to stay in there. It'll come back. They just don't tell you how long until it comes back because you know what? 99% of financial advisors don't know.
Yeah.
So I want people to know that the only downside to real assets like oil and gas royalties is liquidity. It's real estate. You have a deed. It's not liquid. Like you can sell a stock and have your money in your bank account in 3 days. It's not liquid. So you can't put all of your money there. You need some liquidity. Everybody does. But if you've got a large portion of your portfolio in the stock market, you can keep some in cash. I've even heard of some money markets paying 4%. T-bills are paying 4%. There's your cash. Those are completely liquid.
Yeah.
And then you can have real assets, whether it's oil and gas royalties or apartments or rental properties or something that is not manipulated, not controlled by New York and Wall Street banksters, but is a real hard asset. That's how you build real wealth. It's not these paper assets at the casino. It's not. We've been told a lie. In fact, John D. Rockefeller told the truth. He said the most millionaires in the country own real estate. It's not Wall Street. But that's, since the 1980s, that's what we've been told. So I want people to learn that it's okay to take money off the table. You're down a little bit, or if you're in Tesla stock a lot, because it's down like 50%. It's okay to take some of that and put it into real hard assets. Now I get, your 401k, you want the tax deduction. So if you have an employer, you kind of have to do that. But if you can diversify it out of Wall Street and into hard assets, I highly, highly, highly encourage you. You won't look back.
And this is like a key time to do it.
Yes.
Stock market's going down. It may have rallied a minute because of the pause on tariffs, but it's going down. And nat gas, the demand is it's a tsunami.
Well, right. And it's not just saying going down. Okay. Go look up any indicator. Delinquencies are up.
Yeah.
Bankruptcies are up significantly. I think in March they were 20% higher than the last few years. So Main Street ain't doing well.
Yeah.
You've got the repo market going crazy with this basis trade. You've got commercial real estate like high-rise office buildings. Those loans are all coming due.
Yeah.
And occupancy rates aren't great. So, the banks, the reason they haven't blown up yet is because the banks have extended the loans under the current terms, not redone the loans. When they renew or redo the loans, it's not good. So there's all kinds of things that could literally pop this bubble.
Yeah.
We put out the same people that showed us the chart, the Charlie Brown chart, and we're going to link that to this video too. And maybe we even put it in the video somehow. The same group had a chart maybe a month ago or 2 months ago, where it showed the Buffett indicator, Warren Buffett's indicator of is the stock market fairly valued, overvalued, or undervalued, right? He's probably the best investor we've ever known. Everybody kind of admits that. His indicator, using his metric, the stock market was so overvalued, it made 2000, the dot-com bubble, look like a picnic.
Wow.
And the 2008 financial crisis looked like a walk in the park.
Wow.
And then next to it was the Magnificent Seven, the Tesla, NVIDIA, Amazon, Microsoft, Google, and Meta, all driving the stock, and Apple driving the stock market up. Was so overvalued. It was like to the moon, nosebleed levels. And we posted that on LinkedIn and we said, if this chart could speak, it would shout, get out now, run, do not walk. And look, nothing's changed just because it's up today.
Yeah. Right.
They're still way overvalued.
Yeah.
And by the way, those stocks are not down 10, 15, 20%. They're down 20, 30, 40, 50% in less than a month.
You know, Jim, we've talked to a lot of different people about what we do, and some people get it, and then some people don't get it. No matter how much we explain, they just don't get it. And that's okay. It's not for everybody. But something we've observed in some folks is there's like an analysis paralysis. They overanalyze.
Overthink it.
They overthink the asset in a way that they don't think about their stocks and bonds, mutual funds.
Yeah.
So talk to me about that.
That's a good point. People don't know what's in their mutual funds. They don't know when they buy a company's stock. They really don't know. There was an accounting thing passed back in the first Trump administration called FASB 56 that literally says if there's a national security transaction, you don't have to show it. Like you can keep secret books. Well, if you own JP Morgan or any of these big bank stocks, or even Apple, with the data centers, Apple, Meta, all these companies have national security transactions. So you have no idea what's really going on in these companies, but you buy the stock because, you can see it, you can trade it, you kind of know it. That's all you've known your whole adult life. A royalty check is not complicated. It starts out with a lease. It's like a land lease. If you go watch the movie The Founder, which is based on a true story of how Ray Kroc stole McDonald's from the McDonald's brothers, he had a ton of franchises and he couldn't get what he wanted from the brothers who owned the company. So what he figured out with a smart attorney is, okay, I'll buy the land all these franchises are under, and then I will control it that way. That's how he stole it. So that's called a land lease. If you wanted to go open a Chick-fil-A franchise tomorrow, you're probably not going to own the real estate it sits on. You might not even own the building. Somebody else does. That's a land lease. They're going to lease that land to you for your Chick-fil-A for a long period of time. Well, mineral rights work the same way. Exxon comes to our land, our minerals, and say, hey, we want to drill wells, which is their Chick-fil-A franchise, on your property. So we're going to lease it from you. And instead of paying you rent, we're going to pay you a percentage of Chick-fil-A sandwiches that we sell, which is really a percentage of the oil and gas that comes out. It's the exact same thing. It's not much more complicated than that. I mean, you can get into the weeds on anything, but that's basically how simple it is. And when you look at a royalty check, it is not complicated. You have the well, how much oil and gas came out of that well, times the price it was sold at, times how much you own of the minerals. That's it. It's not any more complicated than that. So the risk is if we know the production is going to slowly go down over time, the risk is the price. If oil or natural gas gets cut in half, your royalty check's going to get cut in half.
Mm-hmm. So what I really want to emphasize here on this topic is that, we show all of our homework, very transparent about every asset.
And we keep all of our money in every asset.
That's it. So we have skin in the game, which
every time.
Yeah. So I hope that instills a level of confidence in people that are considering this asset and are maybe new to it and maybe feeling overwhelmed about, this is brand new to me. I don't understand. Well, don't fall into the analysis paralysis trap. Check out the homework. Let's have the conversations and know we're putting our money here. And you can trust that we've got skin in the game and we want to invest alongside you.
That's right.
Yeah. Okay.
Good point.
All right.
Bye, folks.